Welcome, everyone. My name is Katie, and I will be the moderator today. Today's webinar is Tax and Profit, 8 Things to Do Today to Maximize Your Tax Deductions and Maximize Profit before December 31st. I'm excited to welcome Bob Gray and Matthew Donato as our speakers today. Bob Gray is the owner and partner at Gray Pilgrim Associates and has over 30 years experience assisting dentists in managing their practices. He also is the founding member of the Academy of Dental CPAs and a lecturer on tax and practice management for dental programs at universities and dental societies. And Matthew Donato is the national consulting team leader at Cirrus Consulting Group. He utilizes his experience in small business management and consulting to assist dentists in navigating the complexities of dental office leases and enabling them to optimize practice value and minimize risk. Before we get started, I'd like to take a moment to go over quick housekeeping items. If you have a question, please type them into the Q&A box and we'll get back to you as soon as possible with an answer. And CE is not available for this webinar. So Bob and Matthew, thank you so much for being here with us, and I'll pass it over to you now.
Thank you. Thank you, Katie. And thank you, Bob, for joining me. Obviously, this is always a great opportunity to present alongside you. But yes, thank you for everybody in attendance for our webinar today. And quickly, just going to go over a few items to start off with. Really, what's the purpose of today's webinar? Right now, a couple things that we're going to hit on here are the type of leases, right? How do they work? Which one is the best lease for your situation, right? We're also going to be looking at the rate and real estate financial analyses, right? Gaining insight onto what does ownership look like? What does leasing look like? Which one makes the most sense for you? And if you're going to go down those avenues, how are you going to optimize that functionality and how to make sure that you're best protected? We're going to go through maximizing your retirement plans, practice sale profits, any of the hidden liabilities that may be involved in the lease, cost segregations, QBI deductions, and the S Corp versus C Corp. So we have a ton of information to go through with everyone here today. Now, a little bit about myself and Cirrus Consulting Group. Really, why are we, for those that don't know us, why are we able to put on this webinar for you alongside Bob Gray, alongside Henry Schein? Well, we are a healthcare and dental specialized tenant representation firm. We've been around for nearly 30 years, and since our inception have negotiated over 13,000 dental and medical office leases. We have a full in-house legal and leasing and consulting team. So really that's what makes us so unique, is that everything for us is done in-house, right? So a full team of lease negotiators and attorneys on staff, some of which have been with us for over 20 years, as well as some of those that we took from the major national landlord side to negotiate for dentists rather than against them, right? Beyond that, we have our leasing team. Now, what they do is they take a deep dive into the market, making sure that when we are negotiating leases or structuring leases for our clients, that the fair market value of the rental rates are based on fact. It's never a scenario of, oh, we think we should be at $19 a square foot. It's actually, we know that the fair market value for the area is $18.75. Right? And then we have our consulting team, which, as mentioned, I manage and oversee our consulting team across North America. And really what my role and my team's role here is to work specifically with our clients and go through the lease agreement, outlining any red flags, making sure that things are set up properly for your career goals, not only today, but 15, 20 years from now, and give you a tactical plan as what should be done to the lease agreement. Right, we deliver over 100 continuing education accredited seminars, webinars annually, and we're at most of the major dental conventions, the Greater New York, which I'll actually be attending, the Pacific Dental Conference, Yankee, California Dental Association as well. Now, so our first exercise, as mentioned, is looking at ownership versus leasing. And Bob, I'm sure you can attest the number of doctors that you speak to on a daily basis. Everybody wants to own that building, or at least 99% of them do.
True.
And, in some cases, it does make a lot of sense to go down that avenue. Now, but it's not a one-size-fits-all sort of scenario, right? Just looking at some of the quick pros and cons. So when you're looking at buying, obviously you're looking at a much larger upfront financial investment, right? Because not only are you acquiring the property, if it's not already built out to be a dental practice, now you're utilizing funds to go through the acquisition of the property, as well as funds to go through the actual build out of the space as well. Right. The good thing there as well, though, is that you do get to become your own landlord. Right. There's nobody dictating what you can or cannot do. I know, though, that some forget that if they have a building that has multiple tenants, that means that you have to be a dentist and a landlord at the same time, more often than not. What you don't want to have happen, which I've heard in the past, is a tenant coming into the waiting room of the doctor's office with a plunger in his hand, going, "Hi, doctor, sorry, but my toilet's clogged. I need your help." All right, so it's not always the best case, but it all depends on you, like I said. You also get to earn a rental income, both, being able to take it from one pocket to the other while you're an owner occupant, and then looking at some of that residual income should you retain ownership of the property post sale of the practice. Right? Once again, greater flexibility, freedom to control the property as well. Now, when we're looking at the leasing component, right, this does require a smaller upfront investment, whereas you're looking at only building up the space in that case, typically. This also then gives you greater working capital towards building out that practice and the flexibility to relocate or expand should you need to. I can't tell you how many times I've spoken to doctors that went, "Okay, well, I bought the building, everything's great, but Matt, I'm producing way too much. I need to expand my space, and that area will not allow for a larger building on that property. It's not zoned for it." So make sure that when you are making any of these investments into the property, you know what it might have to look like 10, 15 years down the road. But the main thing here that ties all of this together is the dental office lease. More often than not, I hear a lot of doctors that go, "Oh, Matt, I don't need to worry about a lease. I own my property. I don't need anything. It just doesn't matter." I know, Bob, you and I have talked about it before. That's a no-go. We need to have some documentation. And it's not only documentation for Bob's purposes, but it's also documentation for your own purposes as well. What do I mean by that? Number one, if you're looking at selling the practice in the future and you want to retain ownership of that property, having a lease agreement already in place when the valuation is being completed is key. It also just clearly outlines whose responsibility is what, right? What we don't want to have happen is that the dental practice is responsible for all the maintenance outside, but somebody slips and falls on the patch of ice and somebody wants to sue and they turn around, they can go after the dental practice. In fact, I had a doctor in Michigan I was working with a couple of years ago that had exactly that occur. He was an owner occupant, never had a lease agreement separating anything. He did have one corporation that owned the real estate, the corporation that was the dental practice. But when one of his patients stepped outside the practice door, they slipped on a patch of ice and cracked their pelvis. They turned around and went after the dental practice. Add deeper pockets, add more liquidity, and they ultimately got a lump sum of money. But this all could have been avoided if you had had a proper lease in place separating the liabilities of each entity. Right, and that brings me into my next point, which is the ownership exercise. So I'm not going to go through each and every point here, but what I would implore everyone on today's webinar to do is just take a quick picture of this and take a look at question 1 through 8. How many of the answers do we actually know to this, right? And what does it actually look like, right? Obviously, as we just sort of mentioned, who owns the building? Is it personal or is it a corporation, right? Who owns the practice? Is it a personal or corporation, of course? And number 3 is key. Are you paying yourself rent today? Because if you are paying yourself rent, right, you're taking from one pocket, giving to the other. But what we don't want to have is that we're drastically understating the revenues of the practice, or on the other hand, that we're just allocating the funds to pay the mortgage, but the rental rate is $20 a square foot more than it should be in that market. Because that's going to create a problem for you when you're looking at transitioning, when you're looking at anybody else valuing the practice and going through that process, right? So very important, like I said, just to take a look at everything through here and really identify what is the state of your estate, right? If you're to rate it on a scale from 1 to 10, be as unbiased as possible when you go through, because you have to look at it in a sense of what is this impact going to be potentially in the future if I don't do X, Y, and Z. The next component here is the leasing exercise. Once again, just take a quick picture of this, but some of the key components to note. When does your lease expire? You'd be surprised how many times in a day I ask the question, okay, doctor, when does your lease expire? How much longer do we have on the lease? And I get, I'm not really sure. I think maybe a year. And then we look at it 6 months from now, right? Or get maybe 3 years and I look at it, it's a year from now, right? Know when your lease expires because that plays directly into your option to renew. If you miss your option to renew, your ability to stay within the space is null and void. Right? I'm dealing with a doctor right now that unfortunately missed their option to renew deadline, didn't do anything about it. The landlord turned around and said, here is a 100% increase in your rent if you would like to stay. If not, you can be out on the termination date, which is December 31st of 2023. They got this notification September 15th. So very important, everyone on the call, that you know when these dates are. It is extremely important because when we're talking about maximizing profits, we're talking about moving into year end. We also want to make sure that we're not putting ourselves into a precarious situation where the landlord is now able to dictate what you are going to be paying for, right? And how much that increase is going to be. I have another one that unfortunately is being faced with a 150% increase through their rents, right? Make sure that you're aware of all the liabilities, make sure that you're aware of all your dates, right? Are you liable personally on this lease post-sale? Are you going to be responsible for the future sins of your buyer, wherein they're going to keep you liable, right? A number of these components, not to mention relocation or demolition rights, which have extremely heavy implications, not only on your ability to sell the practice, but also on that valuation of the practice as well. Now, when we're looking at some of the terms to be cognizant of when we're looking at potential transitioning, we're looking at anything that has to do with the lease, these 7 are some of the biggest, right? It's your assignment provision that gives you the ability to sell the practice, to whom you can sell to, what the landlord's involvement looks like. And we'll go through that clause in a bit more granularity shortly. Rental rate increases. What does it look like over the next 5 to 7 years? Is it based off CPI? Right? For those that aren't aware what CPI is, that's your consumer price index. That's basically what did the basket of goods cost last year versus what they cost this year, and what was the increase in that, and how much more is your rent going to go up? I had a doctor that's dealing with an 8.37% rent increase because they wanted to go off CPI in their specific area, right? Not a great metric, right? What it cost to buy bread yet last year versus what it cost to buy bread this year shouldn't actually have an impact on what your rental rate is going to be last year to this year, because it's not a direct equivalent, right? Other things like consideration language, this gives landlord access to proceeds of sale, surrender of the premises, death and disability. If God forbid something is to happen to you, what is your estate's ability with that lease? Those that don't know, a lease agreement is binding to all successors and heirs. So if you're unfortunately to become physically injured, mentally incapacitated, or worst case scenario, to pass away, what happens to that lease with your family? Typically, they're now responsible to take care of all the obligations of that lease. And if your spouse or your beneficiaries are not dentists, they can't run that practice for you. So make sure we're aware of that. Personal guarantees, and of course, the financial terms. And now, as we're talking about the financial terms on the lease agreement, here's once again just 7 key financial negotiables that we can deal with through the negotiations as we're looking at potentially renewing the lease agreements, as we're looking at maybe for those that are looking at starting a practice, adding a second location, expanding, whatever the case may be. These are the negotiables. Most doctors that I speak to go, well, the number is the number. This is what the landlord has told me. They're not willing to budge. Well, are they not willing to budge because that's the actual lowest that they can go due to their stakeholders, what have you, in the background? Or is it the lowest that they're willing to go because they know you don't know otherwise, right? It's very important to do the research on the area, but also looking once again at those annual increases, those common area maintenance fees. I know that everybody sees that all of a sudden they're responsible for the HVAC unit that needs to be replaced. Well, how much is that going to cost? What's the implications? So on and so forth. once again, I just advise everyone, just take a quick screenshot of this. These are key numbers to know and all part of the process when we're going through the negotiations. The next component here, I'm not going to go through every single one, but these are some of the key traps that can be hidden in your lease agreement, right? Knowing what you own, knowing what is your property versus landlord property, knowing what your options to renew look like, that death and disability clause, as mentioned. There's a number of components in here that are all hidden within your lease agreement. Most people look at the base rent, the term, the name on the lease, and the guarantee, and they go, okay, that's good enough for me, right? But if you're about to sign $1 million check, it's important to know what those other 50, sometimes 60, 70 pages contain as traps with that check that you're about to sign, right? If I'm about to sign over $1 million, I want to know every single string that's going to be attached with that money. Now, I know that through some of the polls and situations or otherwise, there was a lot of people that were coming up to their expiration of the lease, probably looking at renewing their lease agreement soon. I know a lot of leases end around year end or the beginning of next year. And when we're looking at the option to renew clause, for those of you that aren't familiar, this is the provision in the lease that gives you the right to renew the term, right? It gives you security and peace of mind. It ensures that you have runway to keep practicing. But also, on the other hand, anybody that's coming in to look at acquiring the practice is going to need access to these options to renew more often than not to ensure they have the necessary amount of term on the lease in order to get the loan for the acquisition. Right now, we're dealing with about 10 years is what's required by all the financial institutions. Right? Now, this is sort of your standard option to renew clause. It's found in about 90% of leases. And this is going to go through what your abilities are. And now there's a number of red flags in here. So I'll give everybody just a couple moments to read through this provision, and I'll go through what some of the issues are. Like I said, for any of you that are looking at renewing the lease, be very mindful, very cognizant of what you're about to agree to by exercising this option. So as you can see here, there's sort of 4 major red flags just in this couple lines, right? And now the first one is that provided that Dr. Joe Black shall remain as the tenant. Now, the problem with that, you're probably wondering, well, Matt, what difference does that make to me? Well, what that means is that if Bob has the option to renew and Bob sells the practice to me and I want to use that option to renew, I can't, because that option is personal to Bob. So for any of you that are looking at retiring, looking at selling the practice, what that would mean for me is that if I was looking at acquiring the practice, I can't use your options, and therefore it's going to be very difficult for me to receive the loan for that acquisition. Now, it then goes on to state that any such renewal shall be on the landlord's then standard form lease. So if you have already negotiated the lease agreement, you have great rates, you have all the wins in the lease that you could possibly imagine, you have exclusivity, whatever the case may be, well, that's too bad, because the moment that you exercise your option and renew the lease, the landlord gets to put a brand new lease agreement in front of you. That could be adding in personal guarantees. That could be adding in the ability to demolish the building or relocate your practice, right? So be very mindful what you're agreeing to. You don't want it to take away all the bad things that have been done in the past, the good things that have been done in the past, and put forward the bad things that can happen moving forward, right? And furthermore, it says that in no event shall it be less than the rent paid in the last year of the original term. So if you've had a great deal in rent and the market actually ends up going down, the landlord gets to say, okay, well, you're going to stay the same or you're going to increase. And you're essentially riding the world's most boring roller coaster, either always going up or going flat, but never coming back down. Right? So make sure that you know what the market rates are, and make sure that if you're looking at exercising your option, you can do something with it. You can base this off of a different metric, right? And it's also based off of the current market rent for renewing tenants in the building. The reason that that's an issue is that you don't know what negotiations anybody else in the building did, right? If this landlord's a hard-nosed landlord, they're really good at negotiating, and there's a bunch of individuals that have come in and just went, okay, well, that's fine. We'll take that rate. Well, you have no ability to negotiate when it's based off a metric completely outside of your control and completely based on other people's abilities to negotiate. Now, what's the cost of this mistake, right? When we're looking at what happens if you can't exercise your option, what happens if you miss it? Well, you have having to unexpectedly relocate at the end of the term, having to absorb a significant increase in rent at the end of the term, or even in some cases, the inability to sell the practice. I mean, $200,000 to $500,000 worth of liability, not to mention if you have $1 million practice, right? Well, now we may have an issue where we can't even sell. Now, with selling on in mind, right, this is the assignment provision, which I mentioned earlier. Like I said, this is the section of the lease that dictates how you can sell the practice, to whom you can sell the practice to, and what the landlord's overall involvement in that process actually looks like, right? Now, here is a sample of an assignment clause, right? Once again, found about 75% of all dental leases. And when we look at this, a plethora of red flags, right? First, you must have the landlord's consent. Now, that in itself is fairly normal. I'm sure if you were the landlord, you would want some say as in who can come into the space, who can leave, etc. But moving on from that, it says that landlord shall have the option within 15 days to either approve your request to assign the lease, decline the request to assign the lease, or 3, terminate the lease agreement altogether. So can you imagine you're about to sell the practice, you're about to get that big paycheck and retire, but the moment that you ask the landlord to do so, they just say, actually, no, Dr. Smith, we're not going to be saying yes. We're actually going to be terminating your lease. Thank you for bringing an interested party to the table that likes our building, likes your practice. Thank you. And I've seen many landlords do this. What they do is they turn around and they say to the potential buyer, hey, listen, I'm going to increase your rent a little bit more than what Dr. Smith was paying, but I know I'm going to save you a big chunk of money on that acquisition price. So does that work for you? And more often than not, they agree because they've just saved a lot of money. Not over the useful life of the lease, but up front, that's for sure. Next is that the landlord shall have the right to revise the minimum rent to be paid during the remainder of the term to the greater of the then current market rent for the lease premises, or 15% greater than the then current market rent. So what that means is that you've gone through the financials, everybody's happy, they've signed the letter of intent to purchase your practice, you're about to proceed, but the moment that the landlord says, okay, we're going to let you assign, but we're also going to increase the rent by 15%. Well, what effect is that going to have on the valuation of the practice? I had a doctor in Colorado that unfortunately had this exact scenario occur. He had to take $250,000 off of his asking price in order to still proceed with the sale. Now, the next component here says that should tenant receive from the assignee or subtenant any rental income, cash goods, or any form of consideration. The operative word there is the consideration. And that this shall be paid directly to the landlord within 30 days of tenant's receipt. So that means, doctors, that anything that you've received for the sale of your practice, that money that you've received for all your blood, sweat, and tears that you've developed over the years, building your reputation, building your practice, the landlord has the ability to come after the proceeds of sale. It's an absolute nightmare when it occurs. I had a doctor that lost $500,000 because that's what the landlord was owed based off of the lease agreement, right? And furthermore, even if you do pay that rent, they've let you sell, they didn't terminate on you, they've increased the rents, they've taken some of the proceeds of sale from you. And then it states that notwithstanding landlord's consent to any assignment or subletting, the tenant shall not be released of its obligations. That means that you've done all this, but you're still on the hook for that future doctor. If they go in default, you're now responsible. So what is the cost of that mistake, right? It's the inability to sell the practice, having to absorb significant increases, remaining liable as a guarantor beyond the practice sale, right? I had a doctor, once again, in Michigan, sold his practice, moved down to Florida, And 3.5 years later, he got the phone call from the landlord saying, "Hi, doctor. Hate to be the bearer of bad news, but unfortunately, the buyer of your practice now got a default and declared bankruptcy. So we need you to come back up here, pay the 4 months of defaulted upon rent and the remainder of the term, or until you find a new buyer." Right, that was over $85,000 out of his retirement savings he had to pay directly to this landlord. Right. So this liability obviously can be anywhere between $250,000 to $750,000 plus. Now, when we're looking at the tenant lease cycle, right, and for those of you that are looking at this webinar, right, we're right near year end. We have a lot of landlords as well that are looking at shoring up deals, right? They have their shareholders, they have their stakeholders that need to see some income, right? So if you're looking at a time to renegotiate and your lease is coming up relatively soon, it's a good time to start those negotiations because landlord representatives really want to get those new deals shored up. But when we're looking at the tenant lease cycle as a whole, the earlier is always better, right? So we typically recommend 24 months. And the simple reason behind that is because for most of you, when you're looking at your option to renew deadline, it's usually 9 to 3 months is the average time frame where the landlord wants to have that notice. And the reason for that is if we look at it, once you get sort of into the 9-month range, into the 8-month range, landlords are very aware that you can't, as a dentist, just pick up and move. It's very different for Bob and I. If we needed to pick up and move, we could pick up and move. We don't have to rip out dental equipment. We don't have to take things off the wall other than some picture frames and what have you. But the landlords are aware of that. So when you start the process early, little alarm bells start to go off in the landlord's mind going, why is Dr. Khan looking at renewing their lease so soon? Why do they want to talk about this now? And it's the short and simple answer for us is that it gives us the ability that should we absolutely have to, we can relocate or we can dangle the carrot of relocation should we need to. And next, in terms of us and how we operate, why we've been so successful, this is just a snapshot of how we operate at Cirrus. And as you can see, we're a very process-oriented firm. But number one is that we gather all the documentation and we identify your practice and career goals, right? There's no point in us sitting here and talking about the lease if I don't understand where you want to be in 5, 10, 15 years, right? A lease isn't just a document that you go, okay, well, I guess it is what it is. No, it needs to be structured properly for you. Whether you're the owner occupant, whether you're leasing, it doesn't matter. It needs to be structured for you around your desires. Right? We would then review the office lease for any risks, right? Going through what are the red flags? What are the liabilities you're exposing yourself to? And number 4 is preparing the market research. How does your rent compare to the market? Are you overpaying? Are you underpaying? As an owner occupant, are you paying yourself at all? Or you just been paying yourself the same lump amount each and every year, right? Then we would go with the outcome and strategy development. We'd go through exactly what that needs to look like. What does the right lease agreement look like for you? And then we would create the economics and negotiate the economics in that case of a negotiation, creating the economics in the case of an owner occupant, right? And making sure that it truly makes sense for both parties. Then we go in and create and negotiate the terms of the lease, those assignment provisions, the death and disability, the options to renew. And then once all of that has been completed, we have the best lease possible. We go to part 8, which is final execution and review. And you'd be surprised how many times landlords, the review part is very important because landlords will go, okay, here you go. Here's the final lease. Let's sign off. And you realize that they actually sent you a lease with a relocation clause and hoping that no one would know. And you get the, oh, sorry, I sent you the wrong copy, right? So very important that you review that again, and then we execute. Right? That's just a generic overview of us and how we operate. Now, as a courtesy to everyone that has attended the webinar today, we are offering a critical dates and risk analysis. This is a $2,000 value where myself, my team will spend 3 to 4 hours analyzing your lease, or for those that are owner occupants, we'll spend time analyzing your real estate situation with you, going through all of the reports or otherwise, and getting on a scheduled call to outline your vision and plan, the traps that we uncovered, what their impacts are going to be, what the ideal lease agreement should look like for you, and how to effectively negotiate that lease agreement or a tactical plan. Like I said, that's a $2,000 value, but as a courtesy to everyone on today's webinar, we're going to be offering that on a complimentary basis. So that's me and Cirrus. Thank you very much. I'm going to hand it over to Bob.
Hey, thanks, Matt. So we're going to switch over and start talking about some tax planning now, but we're also going to weave in many of the things that Matt was talking about and trying to look at the difference between owning and leasing. We're going to talk about cost segregation and a few things. Let me, we're having a technical problem there, Matt. There we go. I do have to say, of course, that we're not really providing technical tax advice. You should always check with your personal advisors. We are a big delay on that. I apologize, Matt.
There we go.
There you go. I am Bob Gray. I'm one of the founding members of the Academy of Dental CPAs. Very proud to be one of the creators of that organization. But I also was an instructor for the Dental Business Institute, instructor for Henry Schein's Business of Dentistry courses, and I do lecture quite a lot around the world. So I'm sure that's why Henry Schein asked me to be here today. When I'm not doing that, my wife and I love going out to Napa and chasing these little boutique 100-point wines. So if any of you are fellow winos, you'll have to shoot me an email and tell me what your favorite vineyard or your favorite wine is. Quick shout out to the ADCPA, because the ADCPA is an interesting organization. We're all over the United States. If you go to adcpa.org and click on the map, you'll find an accountant near you. You know, so many people ask me all the time, though, Bob, what's the difference between a regular accountant and a dental-specific accountant? I always say that if your current accountant can't point to tooth number 8, you really should find one that can. But I mean that because, an accountant who really understands what dentists need, what their tax deductions should look like, if it keeps you from having to ask all the questions. We know what questions to ask you, so it's much easier for us to be proactive in helping dentists pay the least amount of tax they legally can. Today we're going to talk about a couple things. One of the things I need to bring up is this legitimate ERC funds. I mean, everyone's been bombarded with advertisements about the employer retention credit. I want to talk about the QBI deduction and the pass-through entity tax. It's a relatively new thing for many states, so we're going to talk about that today and make sure everyone understands what that means and to take advantage of it. But I want to talk about Section 179. I mean, everyone assumes that equipment should be immediately tax deducted, and that's not always the case. So I want to make sure that you're doing it the right way. As Matt said, we're going to talk about retirement plans. We're going to talk a little bit about S Corps and that sort of thing. So let me just sort of jump right in here. One of the easy things that I want to go over are just a couple of changes here for 2023. Now, the standard mileage, for those of you that are using the standard mileage rate for your auto deduction, went up to 65.5 cents per mile. Gas prices are up and they changed that for index. One of the other things, though, is that the residential clean energy credit was increased to 30%, but it also now applies to battery storage technology, which is basically your Tesla wall. And that's 30%. The government's basically paying for 30% of the cost, not only of the product itself, but the cost of installing it as well. So again, if you're on the fence about that, just realize this might be a good time to consider the possibility of, clean energy and going electric. One of the other topics I want to touch on is just maximizing your itemized deductions. The itemized deductions and the standard deduction. Since the standard deduction has been raised so much through the years, many of you wind up not being able to itemize at all. For 2023, the standard deduction is $27,700. That means you don't have to prove any deductions whatsoever, and you get $27,700. So the problem is that when taxes were limited to a $10,000 deduction back in 2018, that really caught a lot of people down and caught us a lot off guard because we're not able to tax deduct much of the state income taxes that you're paying. Many of you pay $10,000 already as to real estate taxes, and so the state income tax winds up being lost as a deduction. But let me give you an example of the one that says even gifting, because I want to show you how you might be able to swing this just with some charitable contributions. Let's take a doctor who's at the $10,000 limit for taxes, has $13,000 in mortgage interest, and made a $4,000 charitable contribution. You can see in that year that that's only $27,000, but they get $27,700 for free. Which really means that all of the gifting and all the mortgage interest and none of that really helped save anything on income taxes. Now let's take an example where that same doctor who is committed to paying about $4,000 a year to his favorite charity goes to them at the end of this year and says, tell you what, I'm going to give you $4,000 for this year, but I also want to give you next year's $4,000 right before December 31st. I want that to apply to my gifts for next year. Now they've given $8,000 in this calendar year. And you can see now I've got $31,000 in itemized deductions, and I saved about $1,320. And again, that was only for making the same contributions I was probably anticipating anyway. So just realize you might want to time your charitable gifts. That may be the one thing you have more control over when it comes to itemizing your deductions. Let me talk about the ERC. This has been such a big issue since the pandemic. The ERC was intended to reimburse employers who paid their employees during the pandemic and kept them on the payroll in a very broad sense. In 2020, it was for 50%, the credit was 50% of qualified wages, but up to a limit of $10,000 per employee. So you only got $5,000 back, per employee back for the 2020. They expanded it in 2021 to be 70% of up to $10,000 for up to 3 more quarters. So that's $21,000 you could have been eligible for per employee, or $26,000 for one employee for both of those years all combined. So $26,000 per employee. It's a huge potential, but I would tell you that there's been a lot of confusion about who's eligible and what that really means. You had to be able to compare yourself to something before the pandemic to see whether I had actually lost income and was I harmed. If you look back, there's a lot of people advertising. If you see ads like this, get up to $26,000 with your ERC refund, and it's so easy. Here it says it even only takes 5 minutes, get a free tax refund. The problem is many of these companies are basically taking the position that all you had to do was to be affected by the pandemic, not really qualifying the way the government said, and they're filing for these $26,000 refunds. And I would tell you that that's not going to end well for a lot of dentists. Here's the possible consequences, because many of these firms are taking 35%. Let's say you got a $200,000 refund and you paid the firm $70,000 in their fee to file this for you. You're now left with $130,000. What happens if the IRS comes back now and claims that it was fraudulent or you're not eligible? Now you only got $130,000, but you're going to be asked to pay back $200,000 plus interest plus penalty, and good luck trying to get that $70,000 back from the promoter. Who knows if they'll still even be in business by the time these audits come around? And I would tell you the IRS is going to audit them. This is right from the IRS website. Employers warned to beware of third parties promoting improper employee retention credits. And I noted at the bottom, improperly claiming the credit could result in taxpayers being required to repay the credit along with penalties and interest. But they're also talking about referring these out for criminal intent, depending on how large the claim was. So I would just tell you that if you're eligible, file for the claim. Don't hesitate to get money that you're really entitled to. But just don't always believe all these promoters that have been out there saying how everyone's, potentially involved. The IRS, in fact, thought it was so much fraud associated with this, they put a moratorium back on September 14th. They stopped processing these claims until they can come up with a better system of sifting through to try to figure out which ones are real and which ones are fake, or which ones are eligible and which ones are not. Again, if you've already filed a claim and you have a question about it, though, the IRS has a whole procedure in place now to go back and repay that would eliminate the penalty for filing a false claim. So just, again, go back and consider whether or not that's something that you want to discuss. Let me talk about the qualified business income deduction. I'm surprised, again, this came around about 2018, and there's a number of people that still don't really realize how to maximize this deduction. This deduction is 20% of your business income, not W-2. W-2 wages do not count. So let's say I'm a sole proprietor and I made $300,000 for the year and I'm married. I can take a $60,000 tax deduction. Just ignore it like it never happened and write it off. The problem is if I'm a C Corp now and I paid myself $300,000 as a W-2 wage, I'm entitled to 0 QBI deduction. 0. S Corps now have to kind of plan carefully because, as you know, S Corps, you're allowed to pay yourself a combination of W-2 wages and dividend distributions. Clients will always say to me, well, Bob, I'm an S Corp. Why don't I just stop taking W-2? That's great. Right? I'll just take it all as distributions. But the IRS requires you to take what they call a reasonable salary. We could argue endlessly about what reasonable really means. But I think if you look at how you pay your associates, if you look at the typical W-2 for a dentist, it'd be very difficult for you to say, my practice makes $1 million a year, but I want a $25,000 W-2. So it's got to fall in that reasonable realm. But clearly for S Corp owners, I would argue that at least it's easy to argue that 50% of your income comes from you being an entrepreneur and planning the economics of your dental practice with respect to hygiene, maybe other providers, depending on how many associates you might have. So again, that other example, if you were making $300,000 a year, you might easily just take $150,000 of it as a W-2 and the other $150,000 as K-1 income. That $150,000 will be the part that's subject to the QBI deduction. So you would get 20% of that. So it's better than nothing. But again, you want to try to make sure you planned accordingly because 20% is a really big deduction. I want to show you another example in a minute here, how we sort of combine this with Section 179. If you talk about purchasing dental equipment, everyone knows that you can tax deduct this equipment. But what I think they forget is what the real effect of this is. So for 2023, the Section 179 limit is $1.16 million. That means if you buy more, or that's the maximum you can write off in any one particular year. However, the spending cap is $2.8 million. So if you buy more than that, you now have eliminated your ability to take any Section 179. And it's just meant to take big employers and big corporations out of the picture. This is really meant for a small business tax deduction. However, bonus depreciation is unlimited for 2023. It was 100% in 2022. Now it's 80% in 2023. And these deductions work for both new or used equipment. To be qualified, though, the equipment has to be placed in service before 1/1/24. Now, placed in service means it was plugged in, ready to use, and available for use. It doesn't have to actually be used. It had to be there, unboxed, and plugged in. I get the question all the time when it says, well, can I just write my check for this on December 29th? They'll probably deliver it in January. Is that a problem? Yeah, the answer is technically yes, and I want you to know that the correct answer is no, that shouldn't be deducted. Does it happen a lot? I would say yes, it probably does happen, only because a lot of people realize that the IRS does not want to go through the gymnastics under an audit of trying to say, well, now I'd have to refile the prior year return, but I also now have to give you credit the next year by letting you take the deduction then, and it goes back and forth. But again, the correct answer is it must be placed in service. And the other thing is people say, well, what's the difference between these two? What's the difference between 179 and bonus? And the thing is really how states treat those tax deductions. Many states never adopted the Section 179 increases and have capped them at, say, $25,000, which was an old limit from, a decade ago. Many states just froze it at that and realized it was in their best interest not to adopt that. Pennsylvania, for instance, is $25,000. California has limits. Many states have limits, where some states put the limit on 179, but not on the bonus. And so, again, talk to your tax advisor about which one is right for you. Either one of them can create big deductions. Let me show you an example, though, of what the tax effects are of buying some equipment. Let's say you buy something on November 1st. It's in my little example here. Through a typical financing program, you wouldn't have any payments for 6 months on a piece of equipment like that. But for 2023, you get a $45,000 tax deduction for that $150,000 purchase. What people don't realize is that because you lowered your taxes for 2023, you've also lowered the taxes you're required to pay for 2024 until the end of the year. That means that you dropped your first quarter estimated tax payment by $10,000 to be still meeting the safe harbor minimum. Again, that means that you're $55,000 ahead. You have $55,000 more in your pocket on April 30th of 2024 because you signed a contract to buy this equipment back in November of 2023. Again, that's a pretty significant, increase in cash flow. And a lot of people will say, well, I'm concerned maybe I'm buying a new Cirrus machine or something and I'm worried about the learning curve. Well, getting $55,000 in extra tax advantages certainly helps take away a little bit of the angst on that learning curve. But I want to make sure everyone understands it affects 2024 as well when you save taxes in 2023, because that minimum safe harbor requires you to pay 110% of the tax on the prior year. So when that goes down, so do your minimum required payments the following year. It doesn't mean you don't owe the money, but you can wait now until April 15th of 2025 to pay that extra money. And I would guarantee you that if I said to you today, here's $40,000, and you just hold on to it, don't pay me any interest, and just pay me back on April 15th of 2025, most people would say that's a pretty good deal. These benefits also apply to all entities. In my example, there was a sole proprietor, an LLC, where the W-2 is not affected. If you're an S Corp, though, you just have to do some planning. You really have to make sure that you adjusted your W-2, because creating a loss in an S Corp with all this depreciation is completely against the whole idea of being the S Corp. It defeats the benefit of avoiding some of those taxes. C Corps can do the same thing, but it takes a lot more planning because you cannot take back payroll. I mean, once payroll is issued, it's done. So if you know you're going to expand in a year when you have a C Corp, make sure that you adjust your salary down so there's room for that corporation to actually take advantage of that tax deduction that you planned for. Again, all entities, though, can have benefit for doing this. Let me show you an example here of how we wound it in together with the QBI deduction, because this really can be an enormous benefit. For 2023, the QBI deduction phases out for married dentists at $364,200 up to $464,200. And it fades away ratably over that thing. So, but as long as your taxable income is below $364,200, though, and that's taxable income after all the deductions and all the adjustments, you're eligible for this QBI. But look at this example when we go back to purchasing that $150,000 worth of equipment. If you take a doctor without Section 179 in the center column who had $495,000 of taxable income, they had $29,000 in itemized deductions, so they had taxable income of $466,000. Not eligible for the QBI deduction, they paid tax of $112,690 for federal tax. But now I bought this equipment. Now remember, we talked about all the benefits of buying the equipment just from a tax savings standpoint, but look what happens if we compound that now by getting an additional QBI deduction. Because that $150,000 purchase brought my taxable net income from the practice from $495,000 down to $345,000. Now my total taxable income, because of the QBI deduction, is $69,000. So remember, I got a $150,000 deduction for the equipment, and now magically a $69,000 deduction also appears because I planned to fall within those important limits. And look at the difference again. This is just year one, $65,000. I got 44% of my money back in year one on the purchase of $150,000 worth of equipment. 44% of it came back to me immediately in tax savings. So I'm only out 56% of the rest of the money to have to pay that back. That's a pretty amazing, and people don't realize how powerful it can be when you're purchasing equipment to plan it and time it so that it could work out this way. Let's talk about the pass-through entity tax as well. Since 2018, when they limited the SALT tax to $10,000, and that's state and local taxes, many of the states have actually created what they call this pass-through entity tax, which is sort of a workaround. What it means is that your actual practice entity, your S Corp or your LLC, pays the state taxes for you. But that entitles them to take a tax deduction for taxes paid. So in other words, on my S Corp return, for instance, I might take a tax deduction for $30,000, $40,000 of taxes paid by the company themselves. It goes on to my K-1, which flows through to my personal return. So my taxes now are paid on my K-1. But if I had paid them individually, I wouldn't get a tax deduction at all for that $30,000 or $40,000. In this case, I do get a federal tax deduction for it. The states require you to add it back as an adjustment. But now again, getting a tax deduction on your state entity, on your state income tax, can be a pretty big deal. And you'll see the list of, there's a whole number of, quite a few states that have adopted this pass-through entity tax. So if you're in a state that does have state income tax, not Texas, not Florida, not any of the states without any state income tax, this might be something for you to really consider. Here's a quick example I just wanted to show you with an S Corp. So you had W-2 wages, but if you had, in fact, a $17,500 that PTE tax paid by your practice, you can see in the yellow box it lowered your K-1 income, your federal taxable income, and saved you $6,100. And you were going to pay the tax anyway. You were going to pay the $17,500 in state income taxes anyway. But now because your S Corp paid it instead of you, you're $6,100 better off. So make sure if you're in one of those states that you consider that. We want to get back and talking about some real estate issues here. One of the things that people forget, and the potential for a practice expansion, is that if you have actually relocated from a space that you fit out before, maybe you moved into a space and you put a lot of leasehold improvements into it, the minute you relocate and abandon those leasehold improvements, all the rest of that money is an immediate tax deduction the year that you move. And when do you need that deduction the most, right? It's when you've taken on a big mortgage, or you've taken on another big lease. In this example, if you made $300,000 of leasehold improvements in 2013, but you had to amortize those without a cost seg study over 39 years. So if you left the building now in 2023, you might get an immediate tax deduction of $215,000. So you can see that it has a big effect when you're talking about the cash flow effect of making this move or expanding. You can see how that could impact it. The other thing that's a huge impact in the real estate is the benefit of a cost segregation study, or I call it how to turn studs and drywall into Section 179. The Hospital Corporation of America won a case many, many years ago against the IRS when they said, well, it's foolish for us to depreciate all of our building over 39 years. We think it should really be broken out by its components and go against its real useful life. And they won. But now the IRS has created this whole protocol and a whole system that you have to follow in order to not depreciate evenly over 39 and a half years. But you can just see in this particular case, $1 million building was going to even get $400,000 in tax savings one way or the other. But if you're either going to do it for $10,000 a year for 40 years, or you could get a lot of it in the early years, the 20% in the beginning, you could save about $80,000 in taxes in the first 5 years. And again, when did you need it the most? When you're really, angst about all the big mortgage. Here's the numbers. There's a lot of numbers on the page, but basically what we're just showing you is that this is how you calculate the tax benefit of these studies. And this would be if you owned $1 million building. But the same thing can apply if you actually do tenant improvements. You don't need to own the building. You just need to pay for all the improvements that went in there, and you still would want to do a cost segregation study. Because you can see in this example, there's a very significant benefit. $53,000 on a $500,000, there's $53,000 in tax savings over time in order to do this cost segregation study. To put it in perspective, like a cost segregation study, just if you remember nothing else, just breaks the building into its various components of 5, 7, 15, and 39 year, rather than everything being in that 39 years. Here's a quick example. So if I ask you what that is, most people would say it's an outlet. But now it depends on what's plugged into it. Because if it's a fax machine, now that outlet and all the wiring that goes back to the breaker, and even part of the cost of the building permit and everything goes into that one outlet, that might be a $380 immediate tax deduction. Same thing for something that's decorative, like a wall sconce. Again, it's not structural, could be immediately tax deductible as if it were equipment. all the infrastructure, all the electrical work, all the plumbing, all that sort of thing that goes into the building becomes part of that immediate tax deduction. So imagine turning plumbing and wiring and everything into dental equipment, which is immediately deductible. What doesn't qualify is the actual structural, load-bearing walls and the roof. And land never qualifies. Land is not tax deductible under any circumstances. So that just goes on your balance sheet as part of the deal. But again, just remember, if nothing else from this, you want to break your building into pieces for tax deduction purposes. You would also have a big benefit of timing the study. Remember that let's say I built a new building and I bought a whole lot of new equipment, and maybe I had $300,000 or $400,000 in tax deductions just for equipment. Well, now it doesn't really help me to do a cost segregation study that year because I don't want my taxable income to go below zero. You look at the brackets on the left-hand side here. You can see that you can earn, for the $10,000, it's up to $19,900 of taxable income. And remember, if you're married, that was also including the $27,700 standard deduction. So you got a fair amount of money, you're still in the 10% bracket. For 12%, it goes up to $81,000. So you're over $100,000 in actual taxable total income. I would argue that taxes are on sale when they're only 10 or 12%. You really don't want to be using these tax deductions to reduce taxes below 10 or 12%. I'd rather have all these deductions in a much higher, the 32, the 35, the 37% tax bracket. They're much more powerful to save than so if I talk to a doctor and they say, oh, I didn't pay any taxes at all last year. I go, well, maybe that wasn't a good thing. Again, plan accordingly. The taxes are on sale when they're 10%. I think selecting the right pension plan is another one of the things that people often, make a mistake. They'll start a plan, maybe a simple IRA or something else, just a Roth IRA early on in their career, and they just never seem to grow. Or maybe they've got a 401k plan, and they're contributing the maximum to the 401k, and they just keep marching along, but never realize that a defined benefit plan could be so much higher. I mean, you can make a $398,000 contribution to a defined benefit plan if you were age 70. You're trying to catch up. You got behind in your investments, and take a tax deduction for it all in that 1 year. I don't think many don't realize how big these opportunities are. Again, the 401k combo is $471,000. So just realize that, ask yourself at this point in your career, do I have the right pension plan? Is the one that I have fit my goals and fit my cash flow and what I'm likely to do? I want to talk quickly about some tax deductions that a lot of dentists miss. I know there's a lot of recent graduates who are independent contractors in their own LLCs. And when they bought the dental books, loops, articulator, hand instruments, things that they bought in dental school, they were only purchased for educational purposes. And so they're not tax deductible. But the minute you got out and started your own corporation, your own LLC, and you converted those things to business use, all of that dental library, all of those things, they just need to be available for use. And they become tax deductible at the fair market value at the date of conversion. So make sure that you're picking up those lists of things that you brought with you from dental school. Some key takeaways today. Again, tax planning really is complicated. There's so many pieces to this. Just don't wait till April 15th because your accountant can't be an archaeologist blowing off the dust of what already happened. They have to actually be someone who's proactively helping you drive the bus and get to the outcome that you're really looking for. And new equipment does have a really big impact on your tax liability. I think you saw from the example there today. Make sure you're taking advantage of the PTE tax if you're in a state where that's eligible. And choose wisely before taking that accelerated depreciation. Remember, taxes are on sale when they're only 10%. And you can turn studs and drywall into equipment. Make sure that you're thinking about that cost segregation if you've done some major improvements to the building, to a leasehold, or expanded your existing building or built a new building. I'm going to put up my information's up here on bob@gpallc.net. You can type some questions in here or feel free to contact me directly if you think you have some ways that we can help you. But Matt, I really appreciate the opportunity to be with you here today, and hopefully we brought some interesting concepts to a lot of dentists who can dive in before the end of the year.
Absolutely. Well, thank you, Bob, for joining me as well. I think this was absolutely fantastic. And yeah, I hope everyone found our content insightful and helpful as we move into year end here. My contact details can be found on screen as well. We're also just going to pop up a quick poll for everyone too. Feel free to click through that and select if you have any questions or would like to speak directly with either Bob or myself, and we'll get in contact with you as soon as possible. Other than that, thank you everyone for attending, and thank you again, Bob.
Yeah, thanks to all.